Now back to the question. We're going to see how to write the report, and we're going to see how to do part A of the questions first. Okay? Now, first thing we're going to do is we're going to write up all our workings. Yeah, we're going to write up all our workings first. So the workings, okay, the workings is going to be on follow the time. It's going to be 2014, 2015, 2016, 2017, 2018, 2019, and this is going to be your year 1, 2, 3, 4, 5, 6. Why we have year 6? Because of what? Tax. Nuruk 1 is going to be based on your tax 1 year delay, right? If you look at this Norukian government, paragraph number 6, yeah? Paragraph number 6, we are told that Nuruk 1 can be paid up to 1 year after the profits are earned. Sorry, it's going to be 1 year after the profits are earned. That is why we have up to year 6. Okay, now we have this already. This is my main time frame, and this is definitely going to be a year 0 here, which is going to be beginning of 2014. The first thing we're going to do here is going to be our exchange rates. Working number 1, I'm going to show you exchange rates. Now exchange rates, it's simply going to be in euro to a dollar, and we know that it's going to be depreciating. So dollar is going to depreciate, so it's going to be starting off with euro to a pounds of 0.7810 to a dollar, sorry, and it's going to depreciate. And if it's going to depreciate, it's going to be 0.95. $1, you get now lesser euros. Okay, so this is going to be 0.7420. Okay, this is going to be 74. All this is found in paragraph number 18. Dollar to devalue. So every year you're going to depreciate this by 5%. 7049, 0.6696, 0.6361, 0.6043, 0.5741. Okay, dollar devalues. Yeah, dollar devalues by 5%. Paragraph 18. Second workings that we want to do here is going to be the number of units, which is found in paragraph number 14. We're going to put down the meter unit, something like units, okay? The meters. Now paragraph 14, there's a 5,700, 6,500, 1,900, 8100, 6300. These are the units that we have in paragraph number 14. Now the next thing we're going to do here is we're going to determine what's going to be my revenue. Revenue or sales. Now we're going to have a sales price, yeah, sales price per meter, yeah, per meter. And we're going to do this in euro dollars. Yeah, we're going to do this in euro dollars. Go to paragraph number 15. Yeah, go to paragraph number 15. 55,000 is going to be the price. This is per meter, and it's going to increase by 3%. If it's going to increase by 3%, we're going to inflate them by 1.03. So this is going to give you 56,650, and you're going to keep inflating them by 3%. You're going to get 58350. Please check. 60, 100, and 61903. So you're going to inflate them by 5%. Then you're going to get something called total revenue. Now, total revenue, it's simply the addition, the multiplication of this multiplied by this. When you take 5,700 meters multiplied by selling price per meter is 55,000, what is going to happen is you're going to get a very big figure. So what I'm going to write here is I'm going to put here, this is going to be dollar, euros, million. Okay, euros, million. So we can just take off 6 of the digits out. So you're going to get here 313.5 million, 368.23, 636.02, and 486.81, and 389.99. Is that okay? So this is going to be my first important figure for my cash flows presentation. That's going to be my revenue. The next working that we're going to see here is number 2. So this is number 3. Number 3. Let's call this working number 3. Okay, let's call this number 3. Variable cost. Now, variable cost is given here as variable cost per meter. Is given in euro dollars. Yep, it's given in euro dollars. It's going to be at how much? 23,000 as the end of year 2014. So it's going to increase by 5% each year. 24150, 25358, 26625, 27957. Check the figures. 36. Okay, correct. So this is what you're going to get here. Next, you're going to find out your total variable cost, which is going to be euro to a million. In total, euro million. So what you have to do here is you have to take this figure. That is why we have this standard line. Yeah, this standard line figures. You're going to take these figures, multiply by these figures. Make sure you get it right. Multiply, you're going to get these figures. So this is going to be giving you a figure of how much? 131.10, 156.98, 276.40, 215.66, 176.13. Okay, you're going to get this figure as 176.13. Now, the next working I want to do here is obviously going to be royalty. Now, royalty is going to be at a price of $15,000 per meter. Now, $15,000 per meter, and the question got tell us, did they say anything about inflation of the royalty? Paragraph number 16. If you see paragraph number 16, they say the subsidiary must make a fixed annual royalty payment. So this is going to be fixed. So what you can do straight away, you multiply with the number of units. Okay, you multiply with the number of units. Royalty in total $1,000,000. Okay, royalty in total $1,000,000. You multiply with the number of units. So you take 15 multiply by 5700. What is the figure going to be? Is it 85.50? This is going to be in dollar. Be careful, I'm just highlighting these dollars. The rest is all euros. This is going to be in million, and this is going to be in dollar. 97.5 million. This is going to be 163.50 million. This is going to be 121.50. This is going to be 94.50. So you got the royalty here. Royalty is in dollar. What you have to do is you got to convert this back to royalty euros. Is that clear? You got to convert this back to royalties euros using an exchange rate. Yeah, using an exchange rate. What is your exchange rate going to be? 0.7420, 0.7049 from the first working, 6696, 6361, 6043. Now you have to be very careful here, because you have to tell me whether it's going to be a multiplication or it's going to be a division. Now if you want to change this to royalty in euro, euro is the first set of currencies, so you have to multiply. Okay, you have to multiply. When you multiply, you're going to get 63.44 euros. You're going to get here 68.73 euros. You're going to get here 109.48 euros. You're going to get here 77.29, and you're going to get here 57.11. Okay, now so you have royalty workings. The next thing you have to do here is going to be workings number 5. Yep, working number 5, which is going to be working capital. Working for working capital. Now working capital, it is strictly, are we still in line here? Can we see the line? Yeah, are we still in line? Make sure you year 1 all the way up to here. Is that clear? Year 1 all the way up to here, year 2 all the way up to here. I'm still on line, yeah, even though I'm going to the next page. Okay, now sales working capital will be based on revenue. It is 313.5. This is 368.23, 636.02, 486.81, and the next one is going to be 389.99. Now what we're going to put down here is we're going to put down here my working capital requirement. Yeah, we're going to put down my working capital requirement. Now working capital requirement, according to them, first year is going to be paragraph 17. If you see that carefully, initial amount will be 10% of the revenue earned in 2014. Fine, 10%. The next year will be $10 for every $10 change in sales revenue. For every $10 change in sales revenue. In other words, it's 10%. Yeah? There are two ways of doing it, but let's do this way. Take 10% on this, put here first. This is your working capital requirement, 31.35. Remember, this is still in year 1. The requirement are not your cash flows. Yeah? Requirement are not your cash flows. This is what you require in the first year. This is what you require in the second year. 36.82, 10% of it. 63.60, 48.68, 39.00, 10%. Now this is where you have to be careful. This is what you want. Working capital cash flows. Yeah, working capital cash flows. This is what you require. 10% every year. What you're going to do is you're going to put here 31.35. This is what you need to start your life in year 1. Next year is going to be the difference between these two. The difference between these two is working capital is increasing by 5.47. You could also do like this. You take the difference between the sales, multiply by 10%. That is what they mean by every $100 you need to spend $10 extra. Yeah, on the extra revenue you need to spend $10. Yeah, this is a much easier way to do. So you just take the difference between these two. Will be required 26.78. The difference between these two is a fall. You start to recover your working capital, 14.92, and this is going to be 9.68. The difference between these two, and trust me, the last figure is going to be the sum of all this figure. The sum of all this figure, positive, negative, whatever, should give you exactly what? 39. Check. Just total up all this thing. In terms of negative, positive, you're going to get here 39. That is going to be recovered in full, assuming it's recovered in full at the end of the project life. Okay, the next working that you need to show, is going to be your taxation in your Untitled, whatever. Yeah, I'm going to show tax, Untitled tax, Untitled tax at 5%. Okay, Untitled tax at 5%. Okay, the tax we can't determine yet, but we're going to determine later. So we just keep some space down here. Keep some space. Probably leave like 5, 6, 7 lines here for text, and that's it. There's no other workings down here. Probably I'll go to the next page now for myself. So we're going to have the appendix 1 now. We're going to have appendix 1, which is going to be your NPV assessment. Yeah, it's going to be your NPV assessment. Okay, it's going to be an NPV assessment. It's going to be in year 0, 1, 2, 3, 4, 5, 6. So it's going to be year 2014, 2015, 2016, 2017, 2018, and 2019 for tax delays. So we're going to copy our revenue. We're going to copy our revenue figure here. You have it up there. We're going to just copy them here. Yeah, we have it here. Let me use my technology to copy these figures into here. Okay, this is going to be my revenue in this particular period. Then we're going to have something called variable cost, which is in euro dollar million. This is in euro dollar million. Okay, you can go up there. Let me just copy this into like this: 156.98276.40, 215.66, 176.13. The figures are all found up there. Now it's still in euros. We have incremental fixed costs. Yep, incremental fixed cost. Now my incremental fixed cost is going to be 40 million, right? 40 million. Paragraph number 15 at the end of 2014 is 40 million. And this will rise by 6%. I didn't show working up there, but you can just show this here because it's constant every year in real terms. So this is going to be 42.40, and this is going to be 44.94. This is going to be 47.64, and check 50.50. Alright, don't forget there is a royalty expenses in euro million as well. In euro million, we have a working set just now. Royalty expenses. Royalty expenses, we have a workings just now. So just copy that one here. This is going to be 63.44. And we're going to get here 68.73, and you have here 109.48, here going to be 77.29, 57.11. Of course, you got tax allowable depreciation, which is 250 divided by 50 each year, will be 50 each year. This is a non-cash flows. Remember, this is a non-cash flows. We'll use a free cash flow method to add back in a while. Okay. Now what you're going to do, you're going to sum up this thing. You're going to get something called taxable cash flows. Yeah, you can work this out slowly. 28.96. Make sure you get 50.12, 155.20, 96.22, and 56.25. You are still in Europe country, yeah? You're still in European country. You got to be a good citizen in European country, and you got to pay tax over there at 20%. Now it's mentioned in paragraph number 6 that this tax is 20%. Let me bring it up. It's mentioned in paragraph number 6 that this tax is 20% and is paid 1 year after the profits are earned. After the profits are earned. So it's going to be in the following year. So the figure is going to be multiplied by 20%. Check 5.79 in brackets, 10.02 in brackets, and 31.04 in brackets, 19.24 in brackets. Following year, okay? Following year. And this is going to be 11.25 in brackets. Okay. Now, then what are you going to do here is you're going to add back. You're going to add back your tax allowable depreciation because it's not a cash flow in the first place. So you add back, you put in first so that you save your time on your tax savings on capital allowance. You will see model answers are producing in that manner, but this manner is a bit fast. Yeah, you put in and you take back out. So it's 50, 50, 50. Then you're going to have this capital expenditure. Now capital expenditure, you're going to have 1,000 and you're going to get a scrap value of 500 euros. Yeah, government is giving you back. On all this can be found in paragraph number 17. The 500 is found in paragraph 17. The 1,000 is found in paragraph 12. So you got paragraphs 12 and 17 here. Last one you're going to bring in, don't forget, is your working capital. Yeah, working capital. Go back to your working capital. Working is 31.35. Then here you're going to get 5.47, 26.78. You're going to get here 14.92, 9.68, and 39. Okay, once you have finished this, you're going to total this up and you're going to get a net cash flows in euro million. This is going to be 1031.35. This is going to be 73.49, 67.55, 210.10, 124.86, 626.01, and negative 11.25. Alright, you got negative 11.25. Okay, now you're going to have to convert this now. You're going to convert this into your home now. All this while you are still in the foreign land. Now what you have to do, you must follow the steps. For you to gain maximum marks or to pass this paper, you must know the steps. First step, all project cash flows must be in foreign currency. Tax paid, come back home. Come back home, you use an exchange rate. Exchange rate is going to be in dollar, in euro to dollar, which you already have in the first working. 07420 7049 6696 6361 6043 5741. You must careful. You're going to change to dollar. You're going to change to dollar. You need to divide. Yeah, second set of currencies, you always divide. If you follow these rules, you have to be very careful. First set is multiply. Second set is always divide. So when you divide, you're going to be a bigger dollar million. So this is going to be 1320.55 in bracket. This is going to be 99.04. This is going to be 95.83. This is going to be 313.77, 196.29, and you got 1035.93. in bracket is going to be 19.60. Check. Correct. 19.60. Now what you're going to have here, you have come back home. Now you've got to put in whatever is as a result of the foreign project got to do with your local cash flows. You will have some examples like royalty. You will have some examples like your home tax, your local tax. you will have something like contribution loss as a result of export sales or something like that in other questions. Yeah, but this question you only have two. One is going to be your royalty income. Now your royalty income, you go back to your workings and you get the dollar income and put here. For you is an income, for them is an expenses. So you got to plus this one. 85.5, 97.5, 163.5, 121.5, 94.5. But don't forget, once you bring it as your, because of royalty income, Penn company will be taxed in that country based on 25% on that royalty income. So this is tax on that royalty income. So you're going to take 25%. Yeah. This tax on income is not given anywhere in the material. You have to know that if you are going to treat this as an income, you have to pay tax in UK, or sorry, in this country. What country is this? Algeria. So you're going to have 25% on this particular figure. Check. Is it in the same year? Yes, paragraph number 2. Sorry. Number 1. Paragraph number 1. Tax is paid in the same year. So it's going to be 21.38. This is going to be 24.38, 40.88, 30.38, 23.63. Okay, you're going to get 23.63. The other way you can do here is you can take this net of tax straight away. You put 1 minus t to this figure and you're going to get these figures out straight away. Is that okay? Now what is the next thing you have to do is you have to put in something special called additional tax. Additional tax, which is going to be in working number 6. Yeah, additional tax, which is going to be in working number 6. We'll put that figure later. We'll put that figure later. Then we're going to get these figures out called free cash flows. Free cash flows. We're going to have this thing called free cash flows in dollar million. And this is going to be 1320.55. Of course, this one we can't put in first. We're going to put in your cost of capital, which is your discount factor. And I'm going to take 10% for the fact that there's no change in business risk or whatsoever. Alright, no change in business risk or whatsoever. Paragraph number 13. Paragraph number 13, they say there's no risk changes in the profile. So we're going to have that 10% discount factor, and we're going to sum this up to get the present value, and we're going to get here NPV. So the NPV that we're going to get here is going to be written down here. Now you've finished most of the marks, most of the parts here, except for additional tax. Okay, let's find additional tax. Now additional tax in Agile is going to be the additional 10%. Now you must know what is your taxable cash flows. What is your taxable cash flows? Your taxable cash flows is given in this particular layout that you have done here. these figures are your taxable cash flows. Okay, you're supposed to pay tax 20% in Nuruk, but you're supposed to pay another 5% based on this taxable cash flows in Agile. You cannot say tax is based on this. This is after working capital, before capital allowance and all that. Can't base on this figure. You have to base on the taxable profits in that country. Always remember, it's based on the taxable profits in that country. You have already paid 20%. So you still have 5% in your home country. So we're going to copy that taxable profit cash flows first. Taxable cash flows 28.96, 50.12, 155.20, 96.22, 56.25. Okay, 56.25. You're going to have here additional tax. Now additional tax is simply the extra 25 take away 20%, it's equals to 5%. So what is 5% on this figure? It's paid in your home country in the same year. But remember, these cash flows are in euro dollars. Yeah, this additional tax will be in euro dollars. So you're going to have 1.45. You got to pay 2.51. You got to pay 7.76. You got to pay 4.81. You got to pay 2.81. Okay, so all this is going to be in brackets. And remember, you're going to come home on that day to declare this tax and pay tax in that same year. So when you come back home, you got to use the spot rate on that day, and it's in euro to dollar. Euro to dollar, if you're going to change to dollar, you need to divide. Is that clear? You need to divide. You're going to have to divide with 0.7420, 7049, 6696, and you're going to get 6361, 6043. Okay, and you're going to have in dollar million. Yeah, you're going to have in dollar million. Now you need to take this figure and you need to divide with this figure. It's going to be a bigger dollar. All right, this will be in dollar. 3.56, 11.59, 7.56, 4.65. Okay, so you're going to get these figures down here, and what are you going to do? You just copy the same figures into that particular financial assessment that we have, and it will be in the same year. It will be in the same year. So paste it over here. That's it. Okay. All right. Done. Once you have this, you got to find out your free cash flows in that particular year. This is going to be 161.21, 165.39, 424.73, 279.85, and 1102.15, and in brackets you get 19.16. 19.60. Yeah, you're going to get 19.60. Okay, then what you're going to have here is you're going to have a discount factor at 10%. So this is going to be 10%, 0.909, 0.826, and 0.751, and 683, and you got what? 621 and 0.564. Okay, so you multiply with this figure, you're going to get 1320.55, you're going to get 146.54, you're going to get 136.61, you're going to get 318.97. Okay, check. 191.14, 684.44, in bracket 11.05. Check. You're going to get an NPV here plus 146.10. Okay, you're going to get an NPV here of 146.10. Okay, so now we're going to come to a report. To whom? To Board of Directors of Penn. It's definitely going to be from anyone below them. It's going to be finance manager. Call yourself a finance manager in your exam, and the subject here will be Nuruk train line project. Okay, and the date will be definitely be your date of your examination. Yeah, it will be a date of your examination, 3rd of December 13. Now you're going to have an introduction paragraph. Always you have an intro paragraph. This is to earn the structure and presentation mark. So this is an assessment. So you write, this is an assessment using NPV approach to see the viability on train line in Nuruk subsidiary. Final phase project, yeah? Final phase project. Okay, final phase project. Then you're going to say purely on financial ground. Purely on financial ground, this project seems to be viable because it's giving you a positive $146 million. You're going to say, by undertaking this project, shareholders' wealth will increase. Yeah, shareholders' wealth will increase by $146 million. Then you go on to second paragraph. You go on to say business decisions are not made. Business decisions are not made on purely financial ground. Okay, business decisions are not made on purely financial ground. This part of this, you have to think, yeah? You have to think of qualitative factors. You have to think of qualitative factors. For example, think about ethical issues. Yeah, I'm just giving you some pointer for you to think and write on your own. You got to think about some inflation. What if inflation there, it builds up? What about political risk? Okay, explain. Yeah, don't write in point forms. Yeah, explain. Political, and then you have to talk about rail options. Yeah, rail options. Do you have any rail options attached? All these things. Yeah, we're going to say here we got a political issues and all this stuff. Okay, then the third paragraph. This is a standard operating procedure, right? This is a standard operating procedure. The third paragraph will be what? Risk evaluation. Yeah, risk evaluation to be done. Risk evaluation to be done before coming to final conclusion. Before coming to final conclusion. Now you must remember, cash flows are only what? Estimation. Yeah, cash flows are only estimation. Therefore, suggest to do risk evaluation, risk techniques. Yeah, risk evaluation techniques. Example: sensitivity. Maybe we can talk about duration. Maybe we can talk about the value at risk. Yep. Alright, that was the first part A of the question. Now that was part A of the question. The next part is going to be part B, 5 marks. What are the assumptions made in arriving at this financial assessment? Now this is straightforward assumption. Assumptions. We have seen many assumptions. Yeah, we can make a lot of assumptions here. The first assumption is going to be foreign exchange. Foreign exchange devalues in a constant manner. When I say devalue, I'm talking about the dollar. Dollar is devaluing, is it right? Dollar is going to devalue at constant manner. First point to say. Second point to say is going to be inflation rate is constant. Specific inflation rates are constant for each of these particular variables. Tax rates is constant. Yeah, tax rates is constant. So these are the assumptions that we're going to make. Tax rates is constant. Scrap value is agreed today itself. Yeah, scrap value is agreed today itself by the government. Remember the 500 million. Yeah, sometimes this may change. This may change depending on the machine condition. Alright, depending on the machine condition. Then you're going to say loan finance, which is going to be either in the syndicated loan or the whatever Islamic bonds. Yeah? Loan finance can be obtained without issue. Okay, this is what we're going to write here for the second part B of the question. So we have finished part A and part B. Moving on to part C.